So I don't think you can look at Bollinger Bands without at least having a look at Keltners. Now I think Keltners are really underused. I think they're a great tool. You know, in some ways they're better than Bollinger Bands, and I'm going to go through some of the reasons in a minute. But Keltner Channels, spelt with a K, are a very similar style to Bollinger Bands. There's an upper channel, a lower channel, and a median or a mean or a midpoint or whatever you want to call it. And based on the same thing. The difference between Keltner and Bollinger Bands is that Keltner channels are based off an average true range number. So instead of a standard deviation like Bollinger Bands, Keltner channels are average true range. So they take into account the range of the market as opposed to the standard deviation. So what does that mean as you're looking at it? Well, what it means is that rather than expanding and contracting so violently like Bollinger Bands do, you notice in the last example you had a Bollinger Band, you know, they just suddenly go from that to massively wide and price is sitting somewhere in the middle. Keltners don't do that, and often price will go above or below the Keltner channel for a long period of time because of the nature of the way the formula is derived. Now, how do you use it? In exactly the same manner as you use with Bollinger Bands. You're looking to sell the high, buy the low, and when you're in a trending environment and it's hugging or it's away from, if I scroll back again, I'm on the DAX here, let's give something else a chance. Let's go with crude oil, shall we, for a change? You know, same kind of thing. And in fact, crude oil is a great example because it's got that downtrend scenario, and you can see how often we just literally stay out of the band, showing you the supply demand imbalance. Now the same kind of rule goes, guys, with these indicators is, you know, you're looking to stay on the side of momentum. So selling a mean tag here, didn't get a mean tag, got a little one here almost, and the upper band, and then, you know, if you're combining it perhaps with your divergence of your RSI or something, then maybe the tag of the lower band might get you interested, but you know, a bit broad there. So it's the same way of approaching it. And again, if we look on a range band environment, no better range band environment here, you're looking to buy the lower Keltner and sell the upper Keltner, and you can adjust these as well. The inputs here, generally people like to use two average true ranges. Some people use 3. Now 3 are going to give you less signals. Same with Bollingers. It's going to give you less signals, but it's going to give you potentially stronger signals. If the market is breaking out of the 3 period ATR or part of the formula, then you know that something is going on. So perhaps if you're using it from an alert perspective, so you can say, listen, I don't want to be involved until I know something really serious is going on. And I know that Bollinger Bands often expand and contract and they're going to trigger far more often, but Keltners are going to keep price pretty much contained. And if you look at this, just this crude oil example here, let's remove this line. I'm going to have to, there we go. Then you can see that a 3 period is giving us far fewer signals, but far stronger signals. In the first tag of it is down here, and that's really the low swing, a good momentum point to get low. Tagged it up here just, or not quite, can't quite see. Here, just tagged. You can see very, very rarely do you get a tag, and when you do, it's a very strong signal. So you've got to kind of weigh that up. It's the same with a lot of indicators. You weigh up how frequent you want the signals versus how strong you want the signals. Obviously, you know, you don't want to never ever trade, but you want to get the toss up between a valid signal and just noise. So Keltners are a really good way. Now if we look at a day trading perspective, let's put it on a 5-minute chart. We might have to shift to something else, but we'll see what happens with crude oil. Again, the expansion out of the upper Bollinger, you notice, you recognize the expansion, the news or whatever has come in, it's forced crude oil up here, blown out, come back. When you tag that mean, then that's your kind of first trade or the first tag of the lower Bollinger. And just look at lower Keltner. I keep getting those confused because they're very, very similar. You can eyeball them to see the difference because of the expansion difference, but there are reasons to get confused. The point is, as you push up, you can see how you're hugging the upper channel, using the mean as a guide, using the upper channel as a way to come out. So if you're scalping the long side, let's zoom in a little bit on this and just use some hypothetical scenario. Again, I know we're using hypothetical scenarios, but we've kind of all we've got at the moment here without digging out some prior trades. Expansion, there's your mean. You're starting to scale out as you touch the high. You're looking to get back in as we tag the mean, scale out as you touch the high. You can see how that kind of just frames price in the scenario where demand is outstripping supply. If it's vice versa, it's going to be sloping downwards. There's your Keltner. Price is going to be just sitting in that lower channel, and the point is you're looking to get short here, you're looking to cover it here, looking to get short here, looking to cover it here. That's broadly speaking what you're trying to do. So Keltners are great, and the same kind of thing with Keltners and Bollingers in terms of as price is narrowing, the bands are narrowing. As the bands narrow, and then they come to expand again. I lost my drawing pen. Let's get it back out. As they narrow here, when they expand and you get some explosion alert, great, something's going on, I want to get involved, I want to be looking at it because something's happened that's going to move price. So a really good way of framing the trade, stopping you from chasing it if it's in the upper if it's tagging that upper ATR zone, the upper band, framing it in terms of finding a good place to get long when you've seen momentum, and very, very similar but slightly different. Personal preference, I know people use both. Some people use both at the same time, and they like to see the difference when the Keltner is sort of spreading out from the Bollinger, or when the other one's compressing the other, and there's kind of intricate things like that. We don't go into detail too much about that because, again, you can Google it and find loads of strategies. But just a broad overview of how the differences between Bollinger Bands and Keltners, how Keltner is based on the average true range, Bollinger Band is based on your standard deviation, but loads of different ways of integrating it into your trading, whether you're day trading or swing trading.